Strong regular dividends are the dream of every investor looking for passive income, but payments can vary a lot. So in this video, I'm going to show you how you can receive the most consistent monthly income by simply holding just 3 UK stocks. In order to find the 3 best stocks in this hypothetical scenario, I've given myself some important criteria to meet. The dividend yield needs to be more than 2%. It goes without saying that we need a company with strong dividends. We also need the companies to be fairly close in dividend yield. We want consistent monthly income, so we can't be having a company that pays a 2% dividend yield and then another company paying 10%. I'm going to give myself within 3% of a yield. The market value needs to be above £1 billion. That's all of the FTSE 100 and around half of the FTSE 250. We want big, stable companies, so we're not taking on too much risk. We want to see positive dividend growth. So we want companies that have a track record and the cash flow to be able to support and sustain a growing dividend over time. So that ignores all the ones that just pay a one-off dividend. We want to see this consistent and sustainable as well. We also want to see a positive share price. It can have a relatively flat share price, but we don't want to be seeing consistent negative years. It may have a 10% dividend yield, but if the share price is falling by 10%, then we're not actually going to be gaining in the overall terms. We want to see the payout ratio less than 100% or the dividend cover above 1. Sometimes you'll see companies with a payout ratio of above 100%, and that means they're paying out more in dividends than they had in earnings, which isn't sustainable long term. In this scenario, we also need the companies to pay a quarterly dividend. Some companies will pay annual, semi-annual, or quarterly, and we also need this to be in different months. So for each quarter of the year, those 3 months will have 3 separate dividend payments from each of the 3 stocks. And also for this scenario, because we just have 3 stocks, we want some level of diversification. So for example, we can't have BP and Shell. They need to be in different sectors. With that, let's get into it. The first company we have is GlaxoSmithKline. This currently has a dividend yield of 4.08%. It has strong dividend growth of 5%, and the payout ratio is sitting at 72.8%. And it pays out in January, April, July, and October. Share price performance is relatively flat, and that's why I put that caveat in about share price being flat is generally okay if it's backed up by financials. And this company does have strong financials with steadily increasing revenues, and it has a reputation to boot. So this combined with strong consistent dividends makes the cut for me. Next, we have British American Tobacco. Just before we move on, if you don't want to invest into a tobacco company, I do have an alternative for you, which I'll show you at the end. British American Tobacco has a strong dividend yield of 6.05%. It has dividend growth of just over 2%, and it pays out in the months of February, May, August, and November. You will notice that the payout ratio says 170%, but we just need to dig a little bit deeper here. It's too boring to go into too much detail, but essentially this is a one-off accounting charge. It's what's known as a non-recurring item. In 2023, they announced a $31 billion impairment to the value of some of its US cigarette brands. This meant that those brands' value on British American Tobacco's balance sheet was adjusted to a finite lifetime, and this resulted in a non-cash impairment charge. And because this charge goes through the income statement, it actually reduces earnings per share, and that's why it increases the dividend payout ratio. But when you adjust for this one-off charge, the dividend payout ratio is actually around 66%. In terms of share price, they've had relatively strong growth with around 53% over 5 years. Their financials look strong, and they are adapting their business model in an ever-changing environment. Then we have Shell. They currently have a dividend yield of 4.07%. They have dividend growth of 1.46%. And crucially, they pay out that dividend in the months of March, June, September, and December. Share price-wise, it can be cyclical as it does track oil markets, but over 5 years, it's returned 170%. So combine that with a strong, consistent dividend, it's a really good stock to own. If you wanted a different stock for these months, you could also look at a stock like Unilever, which pays its dividend quarterly in exactly the same months. And if you did want something slightly different to British American Tobacco, it is slightly difficult because we are looking for specific months. So there might be lots of other companies which you could fit in, which meets a lot of their criteria, but we need them to fit the months of February, May, August, and November. And the only stock that comes close to that meets all of our criteria, is the City of London Investment Trust. It is technically a stock as it is closed-ended being an investment trust, but it does act as a fund investing into other companies. The good thing is you get a yield of around 4.27%, and it pays out in the months of February, May, August, and November. The only downside is that, as you can see from the top 10 holdings, you'll see some of the companies we've already discussed, such as Shell, British American Tobacco, Unilever, etc. So there will be some slight overlap if you did go for this, but they're fairly small percentages, all less than 5%. But these are the 3 companies that I would choose: GlaxoSmithKline, British American Tobacco, and Shell. And as you can see, in each quarter, you'll get 3 payments, 1 from each company. I should acknowledge that there are active funds and ETFs that do try to smooth out dividend payments. So for example, they still invest into companies that pay quarterly dividends, but they do the work for you. So they spread that out and make sure you still get a relatively consistent dividend on a monthly basis. But of course, there is going to be a fee for doing so. It's too much to go into in this video, but let me know if you want me to cover these in a separate video. There's pros and cons to what I've discussed in this video, and it is just a hypothetical example. There's no financial advice here. But let me know your thoughts down below in the comments. Thanks for watching, and I'll catch you in the next one.